Like most companies in consumer discretionary, Best Buy is down about 31% year to date. Now, this is a company that was trading as high as about $84 per share earlier this month, but it took a tumble all the way down to about $68.50, and analysts are expecting it to continue to decline. Now, we have to ask, what is the reasoning behind this huge decline? There's a few different reasons, but recently Bank of America downgraded Best Buy from a buy to a neutral because they were concerned over some of Best Buy's earnings in 2023. We can also see short sellers are starting to build their positions in this company, and the options pits lean bearish as well. So with a company that currently yields about 5% for their dividend yield and also has some other positive upside, we're going to be jumping into my stock valuation spreadsheet to see if Best Buy is a stock we should be buying or selling. And on the spreadsheet, we have 4 different valuation models. We have Graham's valuation, a discounted cash flow model, multiples valuation, and our dividend discount model. And all 4 of these valuations will roll into our output tab. But let's go ahead and jump over to our stock screener. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. But let's go ahead and come up here and we're going to plug in Best Buy stock ticker and hit enter. And we can see all of this data is going to fill in automatically. And let's go ahead and zoom out. We're looking at a 365-day chart. Let's make it a 500-day chart. We can see they recently hit all-time highs, but they took a huge dip over the past few months, like we mentioned earlier, about 31%. If we come over here and look at the dividend data, I think this is a very attractive dividend company, currently paying out $3.52 per share, which gives them a dividend yield of about 5%. That is much higher than your typical company in the S&P 500, and their payout ratio is only sitting at about 30%, so that's nice and low, allowing the company to continue to grow as well as increasing their dividend. If we look at these moving averages, the 20, 50, and 200-day moving averages are all sitting at negative. The 1-year return is negative 35%, and the 2-year return is negative 13%. Now, obviously, like I mentioned, they are in consumer discretionary, and with the threat of a looming recession, this is typically an industry that takes a pretty big dive to start out, so that is a little bit of a concern. Analysts do still have a current target price of about $90 per share, with them currently trading at about $70 per share. Institutional ownership's at about 83.4%, which is pretty high, which overall is a good sign. But let's go ahead and jump in and look at Graham's valuation. Now, Graham's valuation is a valuation model invented by Benjamin Graham, who is one of Warren Buffett's mentors, and he wrote the greatest investing book of all time, The Intelligent Investor. And here's the formula he lays out for us in that book to calculate intrinsic value. So you can see the first thing we're taking is the earnings per share for Best Buy, which is about 9.02. We're then going to multiply that by 7, which is the price to earnings of a company with no growth. And then we apply our growth rate projection, which isn't super high. It's sitting at about 6.5. We're then going to multiply that by 4.4, which is the average yield of AAA corporate bonds. Once we have this number, we're going to divide it by Y, which is the current yield of AAA corporate bonds. And at the time of this video, that's sitting at about 4.1. Once we plug everything into this, we can see Best Buy has an intrinsic value of $130 per share, which is much higher than their current price. Let's go ahead and look at our discounted cash flow analysis. And in order to perform our discounted cash flow analysis, we need to project a growth rate for the future free cash flows for this company. So what I've done is I've plugged in the historical free cash flows for the company right here, so we can see how much the free cash flow has been growing year over year. Over the past few years, they've had an average growth rate of about 17.7%, which is extremely high, especially for their industry. Now, moving forward, due to market conditions and their industry expectations, I am projecting a growth rate of about 5% for Best Buy. Using that growth rate, I was able to calculate the future free cash flows for them, and then I found the present value of those future free cash flows. After getting the present value, I added all of those cash flows together. I added Best Buy's cash and cash equivalents and subtracted out their total debt, which gave me their equity value. I then took the equity value and divided it by their number of shares outstanding, which gave me a discounted cash flow price per share of about $154. Now let's go ahead and jump over to our multiples valuation model. And the idea behind our multiples valuation model is using companies that are similar in structure to Best Buy, we should be able to value Best Buy using a price to earnings multiple. So what we're doing is we're taking companies like Kohl's and Dick's, we're looking at their stock price and dividing it by their earnings per share to get our price to earnings multiple. We then take the average price to earnings multiple and multiply it by Best Buy's earnings per share to come to our intrinsic value for Best Buy of $87.64. Now let's go ahead and jump over and look at our dividend discount model as well. And for our dividend discount model, what we're going to do is we're going to value this company based on how much they pay out in dividends and how much that dividend is increasing. So I plugged in how much they've been paying out quarterly in dividends so I can see how much they pay out yearly. This allows me to see the dividend growth rate over the past few years. And we can see I was pretty surprised after doing this analysis to see they had an average growth rate of 18.5%. Now that is extremely high for a company like Best Buy, really high for any company in reality. So for this analysis, I am projecting a growth rate of about 6%. The reasoning behind this is a still pretty solid growth rate for this company, but with their industry, it's likely going to start to decline slightly over time. So after applying a discount rate of about 9%, we can see we got a dividend discount model price per share of $124, which again is much higher than their current price. Now let's go ahead and jump over to our output tab. And here on our output tab, we have all 4 of our valuation models: grams at 130, multiples at 87, discounted cash flow at 154, and dividend discount model at $124 per share. Now, when we average all 4 of these together, we can see we come to an intrinsic value of $124 per share, which is much higher than the current price. But as value dividend investors, we do always want to apply a margin of safety to our investments. So let's say we want to apply a 30% margin of safety. We'll hit enter. We can see based off of this, the acceptable buy price for this company is sitting at about $86.97. So our stock valuation spreadsheet is telling us this is a company we should be buying. Now, I think something that we do have to take note of is this is a company that if there is a recession looming in the future, they will take a pretty large hit, and in the short term, I think their stock price will decline pretty heavily if that is the case. So that being said, I'm not actually currently adding shares of this company to my dividend portfolio. I absolutely love the dividend yield of this company sitting at 5% and the dividend growth rate that we've been seeing over the past few years. I think it does make them very attractive, but I think with that threat of the economic factors that we're currently looking at, I think this is a company I'm going to hold off on buying for now, but I am going to be adding them to my watch list and watching them very closely. If you plan on buying Best Buy, go ahead and let me know in the comments below. If you have any other thoughts, go ahead and let me know as well. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.